What if you never had to learn another strategy again? Wouldn't that be wonderful? Wouldn't that be just perfect? A strategy that you can use across any time frame, any product, Forex, commodities, indexes, shares. Just use the same strategy over and over again. Multiply it, repeat, and carry on. Hello, ladies and gentlemen, fellow traders. Good to see you again. Today we're going to talk about that. Today we're going to talk about how you can scale it up, how you can enjoy trading with one strategy and one system. I hope you're all well. It's good to see you again. Let's talk about risk. Don't forget, if you don't like risk and you don't like losing money, don't trade. Let's get on with it. Let's talk about the markets and let's see where we are. Hello, Elaine. Good to see you. Good to have you on board. We'll wait till everybody gets here and then we'll get on with the one strategy that we always talk about, the one thing that we always go on about over and over and over again, non-stop. The markets have been interesting. They have been jumping around a little bit. Unfortunately, the Brent crude oil trade has not worked out. That's kind of gone against everyone. But the US dollar ZAR trade also went against everyone. And it's amazing how strong it's become. And this morning we looked at going longer again because it was breaking structure, but there is a bit of a red candle there again now. That said, this account is in the long trade on the South African Rand. The S&P has started to fall over, roll over. Is this a kind of situation where just before the holidays everyone starts selling off and there's only skeletons in the trading floor or in the big index money? The guys that are trading with the big money are going on holiday, so they've only got skeletons working in there, so they're selling off and selling off their trades. So that, I mean, these guys are not going to leave like trades on while they go away. So at the end of the day, there'll be some skeletons left behind looking after the trades, so to speak. So there might be a little bit of a sell-off before you get a bit of the Christmas rally where the retail traders come in and the leftover skeletons trade and it moves up a little bit over Christmas. So we might still get that Christmas rally, but if we don't, then it's obviously going to head on down to the support levels. Just trade what you see. And if it looks like it's going to go up, we'll take it. If it looks like it's going to go down, take that too. Don't worry about it. Don't overthink it. Don't get too confused with it. That's why I say we're going to trade with one strategy, one system. Keep it simple. It's so important to do that. And you can trade with it on absolutely any time frame. You can trade with it on absolutely any product. You don't have to be like trade it on anything special. So don't forget, it's coffee with Rob. So we're going to have some coffee. And then we're going to talk about my 34 years of trading and effectively all the mistakes that I've made so that you don't make the same mistakes, but you will. You'll make the same mistakes. Everybody does. Let's go and see what we've got here in the Euro US dollar. The Euro US dollar is moving to the upside still and continuing to go long. It's going to be a difficult period to trade, by the way. If you haven't traded over Christmas before, it is a difficult period because it becomes quiet. It becomes an interesting period because there's not a lot of noise going on. There's not a lot of people jumping up and down and going crazy in the background. There might be one or two news events. For example, there was a news event in Australia this week, and that might have affected markets in one way or another in that region. But it won't affect markets in our region or in other regions, so to speak, because it's not a big enough incident for that. So, you know, when it comes to fundamentals, you've got to look at where the fundamentals are, what they are, and how big they are as well. US dollar, Canadian dollar has come all the way down to the main support, and this could easily turn around and quite easily go long from here. That would be a thing, and I've been telling you the US dollar, Japanese yen has been short since the top here at 158. I told you guys it's short because of fundamentally the Japanese government does not like their yen over 150. It was 158, way overboard. And as I mentioned, it would definitely go short at some stage around there, even if it was to get to 160. But it immediately turned around and started going short. And it's come short all the way down to this level of 154.5. And it bounced off there, went up a little bit, but it is coming back down again. There was a level of money here to be taken, some liquidity, but it's broken through that and is heading down now to the main levels again. And I do believe, in all probability, it'll probably go down to 150. And one of the main reasons I do think it's going to do that, somebody asked me to have a look at head and shoulders for them. And I will put this in to the, how can I put this? I will add this into a normal video, and I will make it a normal video. Head and shoulders. How does a head and shoulders work? Well, effectively what you do is you get the left shoulder, the head, and the right shoulder. And you can clearly see it in the market. The head is always slightly bigger than the two shoulders on the right or left. Does it have to be a perfectly straight line? No, it doesn't. It can be a little bit skew, it can be a little bit off. It really doesn't matter. But what you want to do is draw an imaginary line under the head and shoulders. You can draw a real line there if you want to, but you don't need to. What I look at is if it breaks down below the shoulder. In other words, you get the red candle breaking below the shoulders and it closes. That could depict that it's going to go the distance of the head. So that whole distance from the top of the head to the bottom of the head, it will project to the downside. And that would make a nice 150 on this particular trade. It'll come down to the 150 target that I'm talking about, if it does that. When is the head and shoulders negated? When is it over? When does it not exist anymore? Well, that is if the price goes back up and it breaks the right shoulder. If it breaks the shoulder to the upside, then the head and shoulders is now negated and is no longer in play. It's over. It's gone. It is no more. But as long as it hasn't done that, that head and shoulders remains in play. And if that price breaks below and starts to head down, in all likelihood and all probability, it'll head down to the whole length of the head. Do we trade head and shoulders effectively? No, we don't. Head and shoulders are just there as an indicator, as something to look at in price action. You spot it, you see it, you look at it, you understand it. Now you trade with every other tool that you've got, your support and resistance and your liquidity areas. That's what you're looking for. Your sole job in the market is to look for liquidity areas, and that's what you're going to do. So once you've found those liquidity areas, then you can depict if your head and shoulders is going to play out the way that you want it to. You know, there are other patterns in the market which are really great. For example, the flag pattern, where you get the pole up, you get the little flag to the side, and you can draw the flag in. 9 times out of 10, that will resolve to the upside if it's going up. So you can use the flag pattern to give you an idea of which way it's going to break out of its range, for example. It gives you an idea. So that's what these patterns are for. But the head and shoulders is one of my favorite patterns. The trouble with the head and shoulders is when the market starts to go a little bit pear-shaped, you're going to see a lot of these head and shoulders all over the place, all over the market. So do keep your eyes open for that and do be careful of that particular issue. So I hope you're all here. Hello, Sir Lunch. Good to have you on board. Lovely to see Sir Lunch. Sir Lunch is now trading seasonality, which is quite interesting. And this is the season. Christmas is the season. So this season will give you a lot of information as to what's going up and what's going down. Trading seasonality gives you odds. You're trading on odds, and the odds are on that most years it'll do that on that month and so on. And what you have to understand is why things happen at a particular time of the year. And it's because the way the money flows at that particular time of the year, for whatever reason. For example, at Christmas, like I said earlier, a lot of the big money, the investment money, for example, 95% of the market, as you know, is made up of investment money, big money. It's not made up of retail traders. Retail traders, we make up 5% of the market. The major part of the market is made up of these big institutional money people. They go on holiday. They take holidays because a lot of them live on enjoy the Christmas season. They take Christmas off, so they go on holidays at that time of the year. And when they go on holidays, they're not just going to leave big trades in place. So what they do is they leave a few skeletons in the office to look after what's there, but they can't keep everything. They don't want to keep everything over that period. So a lot of the trades will be thinned out or sold off, which is why you're getting this bit of a pullback now, most likely. I mean, I don't know. But then what happens is you start to get those skeletons and the retail traders carrying on trading, and the money flows slowly because there's not a lot of news flow. Everyone's away, everything's closed, and everything's quiet in the US because the US does push the markets, and it's that time of the year. So then thus you get this sort of flow of a Christmas rally. There's the other ones, sell in May and go away. It's because of the money flow, the way they're moving money and payments and debt and all the rest of it in the country. And it affects the whole world because the US is one of the biggest economies in the world, and it has an effect on the world because most people play everything into the US dollar. And if you play everything into the US dollar, that is going to react to everything that you're trading. So seasonality is an interesting way to trade. And I love the fact that Sir Lunch is trading it. It's absolutely wonderful. Euro Great British Pound does appear to be bearish, but it broke out to the upside. So it looks like it wants to go long now. There's an opportunity coming up for a buy because it's coming back for a retest. It's coming back to do the retest and then head on to the upside. So that's actually looking pretty good for a decent retest. Let's talk about that one strategy, that one thing that you need to use in the markets, the one thing that's going to make you profitable. And then we shall get on with everything else from there. So I'm going to talk about the one strategy, the one thing that's going to make a difference to your trading. And what if you never had to learn another strategy again? What if you could just use that one strategy to trade, the one simple strategy without having to get complicated and have all kinds of lines on your chart, and then you're not sure if it'll work on Forex, if it'll work on crypto, if it'll work on an index. This strategy works on absolutely anything. You don't need to have any particular instrument to trade the strategy. So for example, you have the Brent crude oil here, which is going pear-shaped. And what we've done is we've taken a system called price action, a simple system, and we've said we're going to draw in a resistance and we're going to draw in a support because that's the best way. And then we're going to use trends within that system to show us whether the price is breaking to the upside, whether the price is breaking to the downside. And we're keeping it simple because what we're doing as traders with a system is simply looking for some liquidity. We're not looking for anything other than the liquidity in the market, the money in the market. So how does support and resistance work with that? It's very simple. What you do, let's take a level like this. How does it work? The resistance level is where every single time the price gets to that level, it bounces off. And you have to ask yourself the question, is why is it every time the price gets to that level, it bounces off and it comes down? That's because at that level, there's going to be a huge amount of money lying in that area. Orders left in the market. There could be stop loss orders. There could just be orders to buy, sell, whatever the case. But there's a lot of orders and money left in that area. And the reason you can see that is because every time it gets to that area, it moves away from that area. So that's what you're looking for. Same goes for the support on the upside. When it hits the area, it bounces, goes up, bounces, goes up, bounces, goes up. So we trade three ways on the system. And that is, we trade with the trend. So the trend to the downside, trend is your friend. So if you trade with the trend to the downside, you would be going short. If you trade with the trend to the upside, you would be going long. The other way you trade is in the range. The range is when it stays in between two prices, going to the right-hand side. So up, down, up, down, up, down, up, down. And then the third most interesting way that we trade is with breakout or breakdown, or it breaks structure, which is on the trend. And what I like to do is look at the trend and either trade in the trend or look at the break of structure, or in the range, take my trend, draw my trend in the range, okay, then I can see where my trend is in the range. And that gives me For example, in a trade like this one, which is not working out at the moment, but it was green earlier. But if you get a closed green candle there, broken above that trend, you're looking at a situation where, in all likelihood, it's in this range. There's the bottom of the range. There's the top of the range. It's been bearish, but it's looking to break structure. If it breaks that trend structure to the upside with a nice green candle pointing to the upside within that range, bouncing off a support level, then you've got a possibility of it going up to the main resistance level where the money is, taking the money at the bottom here and moving to the upside, putting your stop loss way below the support levels. But that is as simple as the system gets. And you can trade with breakouts if it reaches the resistance level, gives you a green candle to the upside. We've gone over this a million times and it just keeps on going. Or it gives you a red candle under the support and it keeps on going. Or you can trade with the bounce off the support, with a bounce off the resistance, with the red candle to the downside, the green candle to the upside. A lot of traders will wait for the retest. You don't need the retest. You just need to get into the trade once that happens. Now you know how simple the system is, and we've gone over the system a number of times. The important part to understand is, firstly, you can use this system on every single product, on every single index, on every single crypto, every single share. You can use this exact system. You don't have to change systems. And it doesn't matter whether it's on a 5-minute time frame, a day time frame, a weekly time frame. You can use the same exact system. Not a problem. What you need to do, though, is apply a strategy. And how do you apply a strategy? In simple terms, what you're doing is you're saying, I'm going to risk the same amount of money on every single trade I take based on the size of the account. And the way to do that is to say, well, I'm going to risk 1%, in my case, on every single trade. And let's say it's a $100,000 account. So you're going to risk $1,000 per trade on every single account. And you're going to ask me, but how do you do that? And the reason you keep the risk the same is because then you know what your risk is. Because the plan here is to make more on your wins and lose less on your losses. And this is where the confusion comes in, because every single trade you take has got a chance of losing and it's got a chance of winning. You can't guarantee any trade whatsoever. There is no way you can do that. Doesn't matter what your system is, doesn't matter what your edge is. What matters is you can't control. You cannot control whether you're going to win or lose a trade. Every single time you click this button, every single time you click buy, and you say it's buy market, every single time you do that, do you know what? You've got a 50% chance of winning and you've got a 50% chance of losing. And how do you work around that? Because the only way to really win in the markets is time in the market, because nobody can time the market. And no matter what your system, like I said to you now, you have a chance of losing. Now, what's the point of trading if that's the case? Well, here's the trick, and the trick is simple, and I've given this to you over and over again as well. The trick is so simple, and that is all you have to do is manage the risk. So now we've decided that it's 1% on the account. This is 100,000 accounts, so it's $1,000 per trade. All you do, the first thing you do is you say, look, I want to go long, and I want to put my stop loss over there. So my stop loss is now at 1663. In other words, that's where my stop loss is going to be. And this is a little thing I get off MQL5 for the MT5. If you want to do it on TradingView, I can show you that as well. That's quite easy. You just work out the size of your trade. But the first thing you work out is where you want your risk. And I want my risk far away from that support. I want my risk down below here, because if it gets there, it's invalid. And then I want to see if my take profit is going to make me a large sum of money. So let's say it's at the last high, and the last high is at this point at 1712. Okay, so we don't have to go all the way to the top. We can just say we want to get to the last high. So if I put my stop loss in this area, I put my take profit in this area, clearly I'm going to be making a much better reward than I'm risking. And that's the idea, is to make more on your wins and lose less on your losses, because you're going to lose a few trades at $1,000. and you're going to win a few trades at $2,000. This is not an exact 2-to-1, but it's a win. Now you can work out your lot size. What's your lot size? 0.97 if you want to take that risk. So this has now given you the exact size that you need to trade. You can work that out manually, or you can, on TradingView, it does this for you. And on this one, you're going to need to download this little, let's see what it's called. I do have it here. And it's called Position Size Calculator Gadget. Position Size Calculator Gadget, and it just looks like that in the picture. Just download that. You have to load it onto every chart if you're using MT5 or MT4. If you're using something else like CTrader or TradingView, that normally calculates it for you when you're trading. Then all you have to do is manage your trade. In other words, you take the trade. You know where your take profit is. You know where your stop loss is. Now all you have to do is manage the trade, and don't get out of the trade. What you want to do is follow your stop loss up to cost when it starts going into profit, and then follow your stop loss up behind it like a trailing stop. Do it manually and keep it up behind it. And even when it reaches target, move the target away and keep moving your stop loss up behind it. On the flip side, if it goes into loss, either decide that this is not working out, I want to get out early. The smaller the loss you can take, the better. But don't get upset when it turns and goes the other way for you because you got out too early. Or what you can do as well is let it take out the stop loss and just understand that those are the losing trades, and you're going to make a number of winning trades because that's the strategy. The strategy is simple. You can use this strategy on absolutely any instrument in the market. You can use it on any time frame in the market, and it'll always do good by you because you're planning to make more on the wins and lose less on the losses. And why do I say that? Now, why do I actually say to you that this can work? Well, if you were to take all of these trades here, 1, 2, 3, 4, 5, 10, 15 trades, and you took all of them and you decided on each one whether it was going up or down, either by hook or crook or with some kind of system. You said, oh, I'm going long, short, long, short, long, short. You take 15 trades. On those 15 trades, you take the same risk on every single trade. If you were to lose the first $7,000 per trade, you would be $7,000 down. But what if you won the other 8 at $2,000 a trade and you made $16,000? That would give you quite a decent profit. So that's the basis of the whole game. Now, you're not going to take 15 trades at one time, perhaps. You're probably going to take one here, one there, one that, and you're going to lose a couple, lose a couple, lose a couple. And if you've had a week like I've had, you'll be on a losing streak. So you'll be thinking, oh, when am I ever going to take a win? But when you do take those wins, that's when it all comes together. That's when the money all comes rolling in. That's how simple the system is. Easy, eh? Not difficult in the slightest. Now we can go to the questions and have a look at who's got questions. So someone's watching and waiting for the euro Japanese yen to go short. Good day to all. Good morning, investors. Good to hear from you. So, I mean, if you look at the US dollar Japanese yen and you're waiting for the euro Japanese yen to go short, it's probably going to be similar in one way or another. So let's go and have a look at it simply out of interest. So you say euro Japanese yen. Let's have a look at it and just see. And you're waiting for it to go short. Okay, I'm just going to take this out of the way. Well, the best way to wait for this to go short, firstly, let's draw in a couple of serious lines here and just see what we have, what levels we have. We do have a support level. We do definitely have a support level here. I don't see much of a resistance level on it. And I do see a long, nasty trend going up here. So let's draw that in and see where we are on the long front, on the long-term front, and see where we come out with that. So now I'm just going to make this a lot bigger. You can also do this by taking it to the day charts, by the way. You can go up to the day charts and it'll give you this information that you're looking for on the day charts as well. So look, on the trend, you're very far away. This is extremely far away. So you're going to have to look at a shorter term trend as far as that goes. You've got a bit of something going on here, shorter term on the horizontal line. So you could look at that. This was a resistance, became a support here. So there is a support level here as well. I would suggest on this one, what I would say is I would wait. It's going to delete that line for this blocky to come below that low. So break below this low here. So in other words, you can draw that line back in again, wait for it to break below the prior low, giving you a signal that it wants to go to the downside, move into this range here, because that is in all likelihood a range. I'm going to leave it red. I'm not going to turn it green, but it will become green once it breaks below that. And just wait for it to break below this level. Give you a red candle to the downside, and then it'll be short because it'll be in that space, in that little space there in the system. And you've got a bit of a downward trend here that you can look at as well. So if you want to draw another line, and you can put that in there. If it breaks to the upside on that, then it's going long. As it stands at the moment, it's most certainly looking short. And what I would do is just wait and see if it breaks below that prior low and give you the short to the downside. If it does that, then you've got the short on this particular trade. So that's for the Euro Japanese yen. I hope that helps in somehow way or another. So I hope you guys are all looking forward to your holidays, but as traders, you're probably trading through this period. Even those guys who are on holiday, who normally have a day job and trade on the side, you're probably looking forward to doing a bit more trading over the holidays and keeping yourself busy with the trading because you enjoy trading and you want to make a bit of extra money perhaps. If you're not going somewhere, if you're not going on holiday somewhere or traveling overseas or doing a boat trip or something exciting, then you're going to sit at home and you're going to do some trading. And to do that over a quiet period can be quite tricky because you're not getting all that information, you're not getting all that volatility, you're not getting all that stuff going on in the background. Somewhere close to the 23rd, all of these markets are just going to shut down. And the period between the 23rd and the 1st is going to be really, really quiet. But it will tick up, but it's going to tick up with these tiny little candles. It's not going to have giant candles like you used to. So keep that in mind when you're trading. It's not going to be as exciting as you would normally expect or as you would normally get. It's going to be a lot quieter, a lot more peaceful. The gold bulls, where are you? Where's all the gold bulls? Boy, did this bounce to the upside. This actually shot to the upside. And what I'm actually looking at on gold is, if you look at the long trade, what I would do is I would put the risk, somewhere down here, perhaps even down here for the gold. And I would kind of wait for it to come into the level and then look at getting 4.5 somewhere around there. Not too bad. The risk 1,000 and the take profit 135. It's not the worst trade. Obviously, if we could get this at a lower level, somewhere down here, then you're going to get a much nicer trade, somewhere closer to what was the resistance and now is support. That would give you a much nicer level right about there. If this could come down and just catch it there, you're going to catch a nice trade. $1,000 risk with $2,330 profit if it goes to 4.5. And it does look like it could actually go to 4.5. So gold is actually looking like a good one for the gold bulls. But that said, you've got to wait for it to play out. You've got to wait and see if it's going to break through this green level here, if it's going to break through that and drop off to the downside. because that could be quite interesting as well. See what happens there. See if that goes to the downside. Then let's have a look at what else we've got here today. Bitcoin. Bitcoin's the interesting one. Because on Bitcoin, what I'm waiting for is for it to get down to these lower levels here. And then we take a nice long trade. So what we're looking for is an entry point. We need this. See, when it starts messing you around like this, we need an entry point all the way down here somewhere with a stop loss somewhere down here. Okay. Take profit. Imagine the take profit at 100,000. It's going to make you $4,000 for a risk of $1,000. If you can get this somewhere down here at the support levels. So Bitcoin actually looks like quite a decent trade if it comes down to these lower levels. I just want to see how it's going to play out at the Christmas time and see if we're going to get a good trade there. US dollar, Japanese yen. Yes, here we go. The head and shoulders. This looks short. This definitely looks like a short trade. So if I was to say anything about this, I'll say probably going to get the short somewhere around here. Stop loss risk above that prior high. Target 150, which is way down there. That's a very, very good risk to reward as well. Because there's a head and shoulders there. And the head and shoulders will play out the same length as itself. So that could be a pretty decent trade. Did I just close that? I probably did. So now I've got to get the old, yeah. It's not here, is it? Oh, it doesn't matter. I'm just gonna put it in. That was US dollar, Japanese yen. I sometimes do that. Click the wrong button, you know, especially when I'm on a show like this. There we go. Let's put it back in. I guess I guess I've lost all my my work on it now as well. But that's okay. That's life, isn't it? US dollar, Japanese yen. There's the head and shoulders lying right there. I'm just going to put all the levels back in here so I can see what's going on. So we want a bit of a support level in there. That's pretty good. There we go. That's where the level is. There's the head and shoulders. That's quite neat, isn't it? Let's just draw this in. No. I'm going to leave that out. And we'll draw that one in when it's a bit bigger. See what we get here. It's interesting that it did actually take this money here. That's now gone, so I'm just going to leave that out. We don't need that anymore. I just want to see if it's going to drop below this low, drop below that support, and then head on to the downside, giving us a short trade on the US dollar, Japanese yen. Okay. So, anybody in the chat today? I hope you guys are all liking the show. And hit a like button. Hit the like, give us a like. Yeah. I wonder why. Stream settings. Why automatically generate vertical. I did try to generate a vertical, but it didn't do it. So unfortunately, you got no vertical today for those guys who were watching vertical last week. We ain't getting no vertical this week. For some reason or another, that's not working. Did work last week, but doesn't seem to want to work this week. So I guess that's how it goes. But I wonder why it didn't do it. It's actually quite interesting. But it actually didn't do it. It actually didn't put it in. Perhaps there's something I need to do on my side that I don't even know about. Didn't figure out. I actually don't know. It's quite interesting that it It didn't do it. Okay. Not everybody watches vertical anyway. Most people just watch a normal video. Good morning, Beverly. Good to see you. So it's probably going to be very quiet over the Christmas period for everyone. It's not going to be a busy time for anyone. That's for sure. If you missed the start of the video where we spoke about the one strategy, then just go back to the beginning of the video. It will be there, and we will go on and on about it and tell you all about it. But one of my main questions, like I say, was the head and shoulders, and the head and shoulders, I did go over that as well. The head and shoulders is actually one of the more interesting patterns. If you want to know more about patterns in the market, just go and download a page about patterns and just study the patterns. Also download a page on candles and just study the candles and pick a few that work for you. You know, pick a few candle patterns that work for you. Engulfing candles and dojis and all the rest of it, and pincer tops and what have you. Sometimes you can spot them in the market and that can help you. But what I look for in the candles myself, quite simply, is the tails. I look for the tails. The tails, for example, a tail on a candle will tell me that all the buyers are getting back in, or all the sellers are getting back into the market. Long tails on both sides. The smaller the body, it makes it an undecided situation, an undecided candle. You can use an engulfing candle to tell you which way the market's going to possibly go. There's so many different little candles that you can use, dojis, hammer candles, and what have you. But just remember, a candle only gives you information for the next time period that it's on. So if you're on a 4-hour candle, it's only valid for the next 4-hour candle. It's not valid for the whole week, so to speak. Just gives you an idea if the market might just be turning at that point. Doesn't necessarily mean it will, doesn't necessarily mean it will stay at that point. Whereas the patterns, the bigger patterns, like the head and shoulders, flag patterns, pennants, cup and handles, all these different patterns, they give you much more scope as to where the markets are going. Rising triangles and things like that, they also give you more scope as to which way the market might break out or which way the market might stay. So those are useful. So if you're looking at patterns, you know, just go and download a little page which gives you a picture of the patterns, and then you can start spotting them on your charts when you're working. So if you're busy working, you can just like, there's a pattern, I'll use that. You can spot the pattern and start working with it. That's actually quite useful to a lot of traders, more useful than you might think. But, you know, keep it simple, like I say, and just simply trade on the support and resistance. Some of you might add supply and demand into your trading. It's liquidity, you know, and it normally works very much in confluence with what you're doing in the first place. We haven't seen Shane for a while, but Shane would always use the Fibonacci. And Fibonacci, look, the only thing I don't like about Fibonacci is it puts too many lines in your chart. Yeah, I can do without all the extra lines. But yeah, it kind of, you'll find that if you do use Fibonacci, that those lines are probably going to line up very nicely with your support and resistance levels. It's actually quite insane how that works out. The cycle of Fibonacci, it just lines up nicely into your levels. But I don't like to leave that on my chart because there's too many lines and too much going on. But that's the same as everything. I don't like RSI, MACD, stochastic, all these different things on the charts because they just simply get in the way. There's just too much of them. So if you want to see something like that, put it on and then take it off. Don't leave it on your chart. That's actually a really bad idea. This is the S&P, and it does appear to be sort of falling over. You see, you get this like fall over as well. This is something you notice in the market as well. It starts leaning, and you know, with with anything, if you start putting a lot of weight on the side, it starts leaning over and it starts falling over. It starts toppling. Very much the same with trading. If you put a lot of candles onto that little line there, starts holding it over, starts falling over, starts coming down, starts falling down to the side here. Hello, Blue Mango. Good to see you. We did go over the euro, Japanese yen a little bit earlier. We have got it on here. Did I leave it on? Euro Japanese yen. Yes, I did. Euro Japanese yen. There you go. There's your Euro Japanese yen. And we know the US dollar Japanese yen is going to go short, don't we? So in all likelihood, the Euro Japanese yen is going to go short as well. Probably around these levels, below this level here. Once it breaks below this last low, prior low, then you can put a trade in place with a target, and the risk to reward doesn't look that great if I look at this level. So you're going to have to put your risk really close, and there's a good chance you're going to get taken out of this trade. I'd actually rather go with the US dollar Japanese yen, but if you want to go with the euro, it depends where your target's going to be, because your risk to reward needs to be fair, and I can see the reward or the support is there, and your risk is higher than your reward. That's not good. You're not going to do well out of that, because you're going to have to bring your risk up really close. Good chance it's going to get taken out. There's not a lot of reward in this trade, I've got to say. Not a lot of reward in this trade. But if you did want to take it short, you've got to wait for it to break to the downside here. Flip side is if it goes long and it's going to break through this trend resistance, give you a green candle to the upside. Then it's going to go all the way up. And then I would target somewhere around here at the 185 with the stop losses down lower here as well. Also not a fantastic risk to reward, but if you did go long on this, then your risk would be somewhere down here with a reward somewhere up there. You are getting more reward than risk at least. But yeah, not a trade that I would take today, not my trade. But if you're interested in it, it's pretty much been in a range. It might break back down into this range, or it might break out and carry on. But it is on a breakout trade either way. But as I say, I would much rather have the US dollar Japanese yen, because that's going to give me a lot more reward for my risk. Because my risk can be above those prior highs, and my reward can be all the way down here at 150, making quite a decent reward. It's a much better short trade than the Euro Japanese yen. Just saying. You don't have to trade it that way. Just putting it out there, and you guys can decide for yourself. The DAX is short. Look at this. While the indexes are trying to go long, if you look at the DAX, you've got your nice resistance placed in here. There's your resistance nicely placed at the top, looking good. So it comes all the way up here, hits the resistance, gives you a downwards move. But not only does it give you a downward move, it literally breaks structure. Now the structure is within the range. Now remember, I said to you guys in the beginning, we trade the three ways. We trade with trend is your friend. We trade in a range, and we counter trade. So we've got all three here. So what we've got the range, and it's in that range. We've got the trend, and she's trended to the upside and hit the level. It's come through, and it's broken structure in that range. So now what you've got is a possibility of a trade which says go short with a stop loss on the breakout and a take profit at the support, which is a nice risk to reward. It's a nice trade. It looks decent, and it looks like it might give you a trade all the way down to here. So what it's doing at the moment is probably going back to retest. If you get the retest and you get the red candle coming to the downside, then there's a good chance that it's going to go from there all the way back down to the bottom, giving you a nice short trade all the way down. That said though, if the DAX is going to go short, then surely the other indexes like S&P 500 and the Dow and the NASDAQ and the FTSE, and just to name but a few, are going to go short as well, because the indexes all tend to follow each other. Very seldom that the DAX is going to go short and everything else is going to go long, because sentiment seems to will run right through all the indexes. So now you've got this dilemma, because what's the S&P going to do? And it looks like it might go short as well, because it might pick up to this trend resistance. Hit a level here, turn around and come down. And then the DAX on the flip side might just get to the end, do the retest, turn around, get the red candle and go down. Timing is pretty close. Timing is pretty much the same. But what it does is it negates the Christmas rally. In other words, no more Christmas rally. The thing I'm looking at here, though, on the DAX is this level here, because there's a level of money lying right there. There's liquidity lying there, and it's trying to pick that liquidity up and take it up. If it retests that, there's a good chance, because it's been here once, that it'll just break straight through and carry on down. So the DAX looks short overall, but at a future date, not right now, not this minute, not this candle. It really does. It's probably going to go up and then turn around, come back and go down. DAX is interesting though. It's an interesting picture to look at. Definitely an interesting picture to look at. What's everybody else trading this week? Anything on the go from your side? Very interesting. Still coffee with Rob, so we're still having some coffee. These holidays are strange, aren't they? Every single Christmas, trading becomes a very strange thing. It becomes a very, 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 very quiet thing. Let me put my phone on the charger. Charge. Oh, mind you, it's almost full. I find it a very strange time because everybody's off partying, everybody's having a good time. And then, you know, it becomes so quiet when you're trading. Why is oil here? Where's Bitcoin gone? Ah, there we go. These things move around so much. So Bitcoin, I agree with you, short as we stand at the moment, but on the long term, I'm looking for a long trade here. And my long trade is actually quite interesting. And my long trade is this. I'm looking for the long trade based on this. It must come down to these levels down here. It will come down to these levels down here first. So if you want to take the short, that's your short. But your risk to reward is not very good on the short. But on the long trade, wow, what a risk to reward. Because what I'm looking at on the long trade is in all likelihood it's going to break through this resistance level at 93,000. If it doesn't, you've still got a pretty good risk to reward at 2,000. And at this point, you would have moved your stop loss up, right up behind the trade. And if it comes back and takes it out, you make $2,000. Bearing in mind, this is if you take the trade down here at 81. You can't say this is short right now. But when it goes long, I'm expecting it to go long at around 81,000. And if you take the trade here, you've got this first one. But let's say it breaks through that resistance level and you don't have to get out of the trade. And it goes all the way back up to 105,000, which is its first next level. Then suddenly you're making $4,000. And then let's say it goes up to 120. I don't even want to go there. I mean, at 115, you're already at 5,000. That's a huge risk to reward. So even if it just reaches the first target, you've got a fine risk to reward. So I quite like the long trade on this particular product, but only from this lower level. Don't like the short trade here because where you're going to put your stop loss. The short trade here leaves you with a bit of a problem because your stop loss has to be here, which is not great. You actually need your stop loss above that level, even if it's close by. You need your stop loss far enough away so it doesn't get taken out. And then your take profit is there. So you've got to take profit of $500 or $600 and a risk of $1,000. Your risk to reward is just the wrong way around. So in other words, you're going to have a very tight risk, which is no point because your trade's still valid at that point. So it doesn't work. The short is there. It is short, but it doesn't work on risk to reward. It works for everything else. It works as a trade. Did well shorting the hate diet Pepsi, shorted the NASDAQ. Well done. That's a good one. Just gobbling the rest of the coffee now. Yeah, the NASDAQ was a really, really, really good short. Worked out well. I think it was mostly because of Oracle more than anything else. And this is why I say, you know, when I look at the DAX and I see the DAX going down, and I look at the S&P and it looks like it wants to go as well. And now I'm looking at the NASDAQ and it looks like it wants to continue going down. I mean, you should actually have stayed in your trade. You'll make more money. This is going to keep on going down. It looks like it wants to go down all the way to the support. But this, just like Bitcoin, looks like a nice trade to pick up at these lower levels. Because if it does turn around at these lower levels and does pick up, you're going to get a nice run up. So, yeah, it's been a great, it's still actually a great, if you take this trade short up here, you can stay in it all the way down to the bottom here. And then look for the long trade going up. And I would look for the long trade going up, break of structure on this, going to the upside, moving back up. It'll be great. It'll be such a good trade, man. Such a good trade. So just like Bitcoin, it's actually interesting to see that all the markets are looking a little bit weak. And I'm pretty sure there's going to be a lot of skeletons working in the institutional money this Christmas. Skeleton staff, that is. Because they're going to be selling out of their trades and whatnot. The US 30, even the US 30 is a bit short at the moment. Looks like it wants to come down. There is some money here to be picked up, but it might break through that. It remains to be seen. But remember that the US, or the Dow, is very much, you know, that's made up of your banks and finance and all that sort of stuff, retail, whereas your NASDAQ's made up of all your technical stocks, your techs, your NVIDIAs and Oracles and things like that, Apple, what have you. So that's why I normally like to trade the S&P, because it gives a little bit of a mixture, gives a bit less, you know, you're not relying on one share to make things happen. But it is moving to the downside. I hope I don't talk too slow for you guys, because there was a couple of guys out there that mentioned that they, you know, that maybe don't get to the point fast enough, or I'm not quick enough for them, or whatever the case. But my point on that is if you want to learn and you want to understand what's going on, then you don't really want me just blasting through it and rushing through it and you know, just to make the videos more exciting. It's not going to help you in any way, because you'll get me bouncing around and what have you, but you won't get the gist of what I'm trying to tell you. So I actually believe that it's better that I tell you in a slow, monotonous manner. Maybe it will get through better. But if the guys want faster videos, we can obviously make faster videos for them, more exciting videos. But I'm not in the vlogging business at the moment. So maybe if I start holidaying, I'll start vlogging. But as we stand at the moment, this is a bit more educational. So I don't believe that. Well, I mean, for the videos, it would be great. I'm sure I would get loads and loads and loads of views if I was much quicker, much faster, and much more exciting about what I do. But unfortunately, that's not going to teach you anything, is it? I don't know. Maybe, maybe not. I was looking at that and thinking, yeah, well, that's interesting, you know? Yeah, no, it's insane what people want. With this being a live show, clearly it's going to be a bit more raw and a little less edited. Well, it's not edited at all, is it? Just me talking to you and doing my thing. And that is going to be a lot slower than anything else. So anyone who can watch a live show can watch the rest of my videos as well, because they're a little bit more streamlined than my live shows. I just saw that comment or two, and I thought that's quite interesting. That's not the first time that someone's come up with that, oh no, you know, you don't get to the point quick enough, so I moved on, you know. All right then. Thanks, Blue Mango. I appreciate that. The vids and live shows are great. Thank you. I'm glad you're enjoying them. I just thought I'd bring that up. I don't know what people expect sometimes or what they want, but it looks to me like some people just want instant gratification or fast moving videos and whatnot. And in my belief, then they should be watching entertainment videos. If you want to watch educational stuff, I mean, it's a bit like when you went to school. Imagine your educator came in to give you a subject and started jumping around and dancing like a clown in front of the class. Would that be what you wanted? Or did you actually want them to come and teach you maths? It's interesting. But yeah, it seems what people actually want is the educator to come in and dance around and look like a clown. I don't know. But I know it's not you guys. You guys actually love coming here and joining us as a crowd. So I'd bring it up with you guys. What do you think? It's insane. I mean, look, I know the videos are obviously doing their thing and working for you guys. Otherwise, I wouldn't do them. If nobody was watching them after this period of time and they were total rubbish and, I wasn't helping anyone, then I would be like, okay, I'm wasting my time here. But if I can get through to one person, that one person is going to get something out of it and they're going to go home and they're going to be happy. So that's important. That's really important. Where's all the gold bulls today? Yeah, where is all the gold bulls today? So now we've got another level that's developed on gold, by the way, because now what's happened, gold moved up off its support, beautifully moved up off its support. And it came along, stayed in this range, this very narrow range. Almost, I thought it was a flag pattern, then it went into just a long-term range because it just kept on going. But it resolved exactly like a flag pattern, straight up to the upside. This is what a flag pattern does. A much shorter one, it would just resolve to the upside and go. Now, if you look at this on a day chart, then suddenly it's a flag pattern. Suddenly it's more of a flag pattern. Because if you look at it on the day chart, you've got this move up, you've got a bit of a flag and the move up. So it resolves perfectly. So you can do that. You can just go to the higher time frame and see, well, this is looking a bit off. Let's just go to a higher time frame and see what we've got. Oh, we actually got a flag pattern there on the day. And then you can see that it actually is more of a flag pattern than anything else. And it did play out. It played out that way. Now what you got is it's broken to the upside, moved up, and it's coming back to retest. Now you guys that trade gold should really be watching this closely. If you trade gold often, you need to watch this because this is coming back. There's the level. It's going to do one of two things, and you know that. It's going to go up or it's going to go down. In other words, you're going to get the red candle breaking down, breaking back through this level, or you're going to get the green candle bouncing up and the retest is successful and it's going up. That's why a lot of traders wait for break and retest. It breaks out, they wait for it to come back to retest and then go. I would have thought that this candle was the retest because it came all the way down here, but it looks like it's going for a major retest. And if it gets that and it goes back up, it's going to go all the way to 4.5 if it goes back up. Breaks through here, it's going to break down into this larger range again, and then it's going to come all the way back down to these lower levels. And this will be a failed breakout. The thing with breakouts is 80% of breakouts fail. 80% of breakouts fail. Now, you hear me say that statistic, and it's not like I'm going to pull out a little spreadsheet and show you all the statistics on breakouts or anything like that, or get all confusing about it. So many traders have got little spreadsheets. No, I get that information secondhand. So that's secondhand information. So it could be completely wrong. But in general, I've heard it from a few sources. So it does appear to be correct that 80% of breakouts tend to fail. Let's say 70% to be fair, to give it a bit of, a bit of leeway. But even if 70% of breakouts fail, then you got to know that often you're going to get this little cycle here where it breaks out, sort of hits that level, comes back and breaks back down again. So you've got to know that that's going to happen. The point of breakout trading is when it breaks out and it runs and you follow it well, you get those gargantuan, huge wonderful trades that you always wait for. That's why we breakout trade. I like breakout trading. I enjoy breakout trading because I think that when it does work out, it's worth every penny. Now it just remains to be seen what happens here. But that's why most traders who do breakout trading prefer to wait for the retest, the proper retest, because then they get more success. Then they don't have that 80% failure rate. They rather have a sort of 50-50 rate, closer to, you know, the norm rate, which is like, okay, it could work, maybe not on the retest or whatever the case. I just find that waiting for the retest can be quite a failure in many cases, where you think, oh, I'll wait for the retest, and then the thing just runs off without you. So it's a bit like FOMO. I have FOMO on retests. You know, I'm like, yeah, I'm going to miss it on time. I'm going to miss it. I know I'm going to miss it. I'm going to miss it because it's not going to be a retest, is there? And then it comes back and crashes down. So yeah, I do get into early on those. Yeah, thank you, Elaine. That's appreciated. In today's world of information overload, people want 30-second videos. Very much so. Hey, Diapeps. Yeah, I do. I think your name's Greg. Sorry. In today's world of information overload, people want 30-second videos. But it's not only the 30-second video they want. They want this, like, as I start the video, they don't want to hear me speaking at this, like, for example, the speed that I'm speaking at now. They want it twice as fast or 3 times as fast. They want me to speak like this, like the world is ending, and you know, that's what they want to hear. Okay. And then on top of which, they want cuts. Like, they want the video to be like jumping around, like moving about, and flashy things happening and things falling out the sky and all that sort of stuff. That's what I've seen anyway, from my perspective. So it's not just the 30-second video and the clown dancing around. They also want the video to be super fast and super quick. And I just question that when it comes to an educational video or something that talks about trading, for example, or whatever the case. If I make my voice 4 times faster than what it is now, and if I make things happen really fast all around you and whatnot, it's going to sort of take away from your concentration rather than putting you into concentration mode. Yes, I might be sending you to sleep. That's also possible. But I think it takes away from you by trying to push it too fast and push it too hard. Because what's happening with that is, yes, you're watching the video and you're having fun and it's entertaining, but what are you actually learning from it? You know, and what are you actually watching? So yeah, in some cases, I believe it can work, and people maybe do learn from it and they do figure something out from it, but I think that it takes away from it more than it gives. I don't know. It's interesting. Let's keep it real, you know. Let's keep it real. It's a bit like keep it simple in trading. Just keep it real. Let's not get too out of way about it. Yeah, I do with the videos make it entertaining a little bit, and I do some editing there and try and make it more fun for you guys as well, so that it's not too boring, obviously. But by the same token, I just find it interesting how people think. So yeah, the 30-second video, but it's also the, you know, everything else as well behind it they want. Joseph says, I just came across this channel. Do you also trade DAX during London? We always trade the DAX. And as I said at the beginning of this video, here's the DAX. It's just called the Germany 40 here. Don't worry about it. Sometimes it's Germany 30, sometimes Germany 40, sometimes DAX. It's the same thing, okay? And it just depends on the broker and how they've given it to you and what have you. But as I said in the beginning, trade one strategy, one system over every single instrument, over every single time frame. And that's what we do. We trade price action. And we trade with one strategy, and you can trade everything with it at any time, at any place, okay? You can trade crypto, you can trade shares, you can trade indexes, you can trade Forex, you can trade anything you want, orange peels, whatever. And you can trade it on any time frame. We trade on the 4-hour here. It's swing trade. It's a little bit more relaxing, a little bit more slow. But if you want to do it on the 5-minute charts, you can. It's the same strategy, the same system, the same principle. And if you want to know more about the principle, watch the beginning of this video where I went over it a little bit in detail. But also in most of my videos that I put out on a general basis, I do talk about the system and the strategy that we use, which is very simple and has no real indicators on the chart. All I do is I look for liquidity and I look for trends. We trade three ways: trade with a trend, trade in a range, breakout trade. That's it. There's no complicated issues with it, no lines all over the chart and little squiggly things and indicators and whatnot. It's just straightforward. But there's your DAX. There's your DAX. What's happening with the DAX? The moment it's come off the resistance on the 4 hour, it's coming short. It's broken structure. Looks like it wants to come down, but it has come into a liquidity pool, a supply of money, which is picking up, going up. It'll probably go up, retest, and then probably come down and go all the way down to the support. Unless, of course, the markets decide to eventually go on their Christmas rally, which they should because it's seasonal, in which case it'll break to the upside. And because trading is 50-50. Every single time that you take a trade, no matter what your system, no matter what your edge, no matter how long you've been in the market, no matter how good you think you are, the minute you click that button, you have a 50% chance of winning and you have a 50% chance of losing, because that's the way of the world. That's how it works. Doesn't matter what your system or edge is, or who you are, or how great you are, or how many trades you've won or lost. The minute you click that button, your chances are 50-50. And then the important thing to understand, once you understand that, because it takes a lot to understand that, I get it. It takes sometimes a long time to understand that or to get the aha moment. But once you get around your head around that, and once you figure it out and you say, well, yeah, that's true, then you go, okay, but how can I make money? And then you realize that you need to make more on the wins, lose less on the losses for you to make money, because you're going to take losses. You're actually going to take losses in the market. You're actually going to lose trades. And then you figure that out. And once you figure that out, you realize you just don't want to lose big amounts. You want to lose small amounts and win big amounts. Suddenly it all starts to click. But yeah, as I say, beginning of the video, lots of that in there. And also, lots of my other videos go on and on and on about it. But I've gone through that information and that bit of training already in the video, so I'm not going to harp on about it. And it's a live show, so if you want to watch it over, watch it over. Otherwise, just watch one of the other videos, as I say. Okay. That's right, about 20-25% win rates coming on breakouts. Yeah, your live videos are great, very informative. I like the way you break the charts down to basics with lots of indicators, without lots of indicators. Thanks, Dave. Also, don't wait for a retest. Problem with 25% win rate is getting 8 to 10 losses in a row is common, and most can't handle it. It is, yeah. The big problem with the low win rate and the run of losses is it starts to work on your psyche. It starts to work on your psychology. Even after 34 years of trading, if you start taking a run of losses, it really works on your psychology, because you just can't see when that win is coming. And once you've got the experience and you know that the win is coming and it's going to come at some stage or another and it'll be a big win, then you know, okay, just relax, it'll come. But yeah, that's the difficulty. That's why I don't only trade the one way as well. I prefer to have the 3 methods in our trading. So when I say trade with one strategy, one system, that one system incorporates those 3 ways that we trade, which is with the trend, which is in a range, and breakout. Because if I only trade breakout, then I'm probably going to look at 20-25% win rate, which is not going to work for me. And if I look at trend, then there I've got more of a 50-50, and if I look at range, there's more chance. So you get better odds on your trading. Every trade's 50-50, but you need to win a few trades. And I prefer to win at least 3 or 4 out of 10, because it gives you a better profit at the end of the day and a better run. So while breakout trading is my favorite, it's also, as you say, you know, your win rate is extremely low. Look, as you guys know, I don't believe in win rates. As far as win rates go, win rates don't make you money. And there's a reason for win rates not making you money. And it's because if you have a win rate, it doesn't mean you're making a profit. It just means you're winning more trades than you're losing. But if you have one big losing trade, you're in trouble. And the same flip side works if you're winning. For example, if you have 8 small losses and 2 gargantuan wins, then you're winning. Generally, you want to be making the big wins. And it's basically turning the whole thing on its head, because most traders end up winning 8 trades for a small amount and losing 2 big trades, and then ending up losing their accounts or being in a loss. You have to flip that on its head and kind of work the other way around. And that's the complicated thing about it. Doing things in the inverse is always difficult. Working on the positive side of life is always difficult. It's easy to work on the negative side. So it's important to try and make more on the wins. Try and have those big wins. Try and follow the winners. How often do you meet a trader who doesn't follow the winners, who mostly follows the losses? Most traders that I know will always follow the losses, will always stay in the trade for as long as possible when they're losing. Now, you've got to ask yourself the question, why is that? Why would you stay in the trade when you're losing? It's because of the psychology of, if I'm in a loss and I don't get out of the trade, then I haven't lost yet. That's the psychology. But the reality is you're losing. The reality is you're in a losing trade. But when you're in a profit and you're winning, you seem to somehow think that you own that winning profit, but you don't own the loss. Why is that? You see, it's a psychology. Because when you're winning, you actually are winning. You're winning. You're in a winning trade. So what you end up doing is you click out because you feel like you don't want to lose what you've already won. But it's funny, when you're in a loss, you don't click out because you think that it's somehow going to come back and give you that money back. It's kind of a strange psychology, but you have to flip it around. You have to switch it around, and it is very difficult to do that. And I get that. It's a very difficult thing to do that. So, okay, so this trade is planning to give me another whack. Okay, wonderful stuff. Is it possible to be a profitable trader without the use of indicators? Asked by Bob50420. That's the whole point. That is actually the whole point of my channel. And that is, to be a profitable trader, you don't need charts. To be a profitable trader, you need a strategy. The strategy is a business plan. It's not charts. Charts do not make you money. Charts do not predict the future. You cannot predict what's going to happen next. Nobody can. In fact, the whole point of trading is this. The only way to really make money in the markets is with time in the market, because nobody, and I mean nobody, can time the market. But now that's what we're all trying to do. We're all trying to time the market, aren't we? That's what we do. We time the market. We're constantly timing the market because we believe we can. But we can't. Now, that was my whole point. That's the whole thing of all the years of trading in the last many years, that I figured out that, well, if you want to trade and you can't time the market, then how do you trade and make a profit? Because every single time you click the button, you've got a 50% chance of a win and you've got a 50% chance of a loss. And if that's the case, how am I going to take my trades? How am I going to effect a win? And the only way to do that is with the simple business plan that I give you, my 3-step business plan, which is in all my videos, and it's at the beginning of this video as well. So go back and watch it, because I go over it a little bit. And that is a business plan, a strategy where you make more on your wins and lose less on your losses. It's got nothing to do with your win rate. It's got nothing to do with how many trades you win or lose. It's got nothing to do with the charts. You know what the charts are for? The charts are there so that you can manage a trade. The charts are there so that you can take a trade. The charts are there to give you a little bit of comfort that you actually have some form of edge and you're going the right way in your trade. For example, you're looking for liquidity. So you use the charts to find that liquidity. So here's the DAX that we spoke about now. There's liquidity, there's liquidity. Every time it hits this level, there must be orders there or money, because every time it hits that level, it pushes it away. What am I looking for? I'm looking for that liquidity. That's all I'm looking for. I'm looking for that money. And when I find that money, then I know in that level of area, there's a possibility that I'm going to get the right trade. And if I get the red candle coming out of there, it's giving me some confirmation that it's going in that direction. And then if it breaks structure on a trend support, it's giving me an idea that it's going in that direction. Does that mean that every time I take a trade that I'm right? No, it's a 50-50 trade. When I take the trade, it says to me, you've got a 50% chance of a win and you've got a 50% chance of a loss. Now it's been proven over and over again that you can take even these lines off the chart. You don't even need these lines on the chart. You can take them off and you can have absolutely nothing on the chart. So there's nothing. And then take a complete novice and let them stand next to you, okay? And then you can go and look at all these trades and let them choose the buy or sell. Let that person who knows nothing about trading tell you to buy or sell. You can do the technical side, the buy and the sell, because you understand what you're doing. But then, after they've chosen the buy or sell, manage those trades. Just manage the trades. Manage the trades with your stop loss. Win more on your wins, lose less on your losses. Just put your management into the trade. And you'll be shocked and stunned. You'll probably do better than what you did with your system or your fancy edge or your fancy strategy that you've got. You'll probably do better with that person telling you to just buy or sell. And that's the shocking thing to find out in the market. It's one of the worst things to find out when you've put all that work in. When you've spent years learning how to trade with charts and little systems and little edges and little things. I mean, I myself, I was there. I spent the first 10 years doing that, okay, before I realized. And then you find out that that's not where it is. It's all in a simple 3-step business plan of just making more on your wins. That's meaningless, totally meaningless. But you still need it. And why do you still need it? You still need it because you need a line just to give your brain the psychology that it's going that way. And if it breaks past that point, then I'm out of the trade. It's not working for me. Okay. Or if it goes that way, it's winning for me. You need that. You need that psychology to understand that if it's going in that direction, then it's working or not working for you. For example, this trade has broken below the support. It's going down, big red candles. This is short. So now you understand that if you're long, that this trade is not working for you. You need this to come up and give you a green candle going above there. And then you feel like you've got the edge and it's working for you. But even if that happens, you've still got a 50-50. You take the trade. You feel like you've got the edge. And then it goes against you. And you're a little bit disappointed because it went against you when you were expecting it to work out for you. But once you get to the point where you understand that you are going to lose trades, then perhaps you'll get to the point where you figure out, well, that's how it works. It's all in the strategy, not in the system. But you need a system. You do need a system because your psychology requires a system. Your brain requires a system. Because without that system, you don't believe that you've got the right trades. The management of your psychology, the management of your fear, and the management of the trade is what's going to make you the money in the markets. You are not going to make money having loads and loads of indicators on the markets. The indicators, every single indicator on the market works. Most of them are lagging indicators. What I mean by that is by the time it's happened too late, and you end up with a small portion of the profit when you could have had much more. But yeah, at the end of the day, indicators just confuse you. They just get in the way. And you're going to end up in the never-ending cycle of doom where most traders end up looking for the next shiny tool. What do I mean by that? Most traders get into the market and they search and they search and they search for the next shiny tool, that one system, that one thing that's going to be a winner for them, that's going to make them win in the markets. Finally, it's going to drop out the sky like a magic pill, and it's going to let them win every trade. They're going to have an advantage over all those pros, that 95% of institutional money that's out there. We're going to beat them with this magic pill that's going to fall out the sky. And I'm going to trade it on my charts, and I'm going to make so much money. And they just never find that magic pill, because you get that one and you work with it for a few times, it doesn't work. So then you move on to the next one, and that one doesn't work, and then you move on to the next one and it works, and then it doesn't work, and then you end up back where you started. So I say, keep it simple. Understand that it's a strategy that you need, not a system. The system you need to help you manage your trade. Why do I have lines on my chart? Why do I have a system? So that I can manage my trade. That's all. I want that system there so that it helps me feel better. It helps me manage the trade. Then once I'm in the trade, then I'm in a strategy. And then obviously, what I'll do is I'll look at the fundamentals in the background. I'll understand the fundamentals in the background. Sometimes those fundamentals in the background can confuse you and confuse me. I'll understand that maybe it's a seasonality thing, that it's a Christmas rally. I'll understand that there's, for example, the South African Rand should be weak and it's not because of whatever reasons and the politics in the background. I'll understand that if there's a war breaking out, that the world should be going short and all the rest of it in the markets. So that you can keep your ear to the ground from. So that you know, fundamentally, you know what's going on in the background. Don't worry about the weekly stuff, the jobs figures and all that CPI and stuff. I used to hang my hat on that stuff, and all it did was confuse the earth out of me, because every single time you would think it's going that way, and then they would find some reason for another to make it go the other way, okay? Because that's what they do. They suck you in and then they throw you out. It's really difficult to trade those weekly news items. So stay away from those. But trade on the bigger picture. And if you can see the bigger picture, that'll help you as well. That'll help you in your trading. But yeah, no, indicators, you don't need indicators to be a profitable trader. You need a strategy. The unfortunate thing, like FX Trader says here, it's a psychology of staying neutral regarding the outcome of each trade. Most traders who fail will never get it. And unfortunately, most traders will never get it. Most traders will never get it. In fact, that's why we have a 70% fail in the market. It's not because the charts are useless. It's not because the systems are useless or the strategies are useless. It's because 75% of traders don't get it. They just don't get it. Firstly, they don't understand that they can lose trades. They don't understand that it's not a win rate. They don't understand all those things we just spoke about. And that's why most traders just don't get it. Time the market so that we can set our stop loss closer to the trade. When we say we time the market so we can set the stop loss closer to the trade, all we're doing when we say we time the market, we can't time the market, but what we're doing is we're managing our trade. That's what we're doing, okay? Because we can't time the market. You see, time in the market will always win for you. If you've got an investment account, you'll see that your investment account grows gargantuanly. Go and look for that one video or two videos that I've put out in my system. It talks about investing and talks about how to invest. It talks about how much money you'll make. You'll fall on your back. You'll fall on your back at how much money you can make with investments. That's where all the money is, okay? But none of us are patient enough to sit and wait for the investments to play out just by themselves, because then that's just doing its own thing and you're waiting for years and, what the hell. So you want to do something now and you want to make money now, so you try and time the market. What hit me after 10 years of playing the fool trading and thinking I was clever, and then for the next 24 years realizing that you can't do that, then you have to do it this with the strategy, is effectively, it hit me that if you can only make money with time in the market, you need to do something different. Timing the market's not working. And that's why I know all these different indicators, is because I traded with them all. I was one of those traders who spent my time looking for the next magic pill, looking for the next system in the cycle of doom. I did it. That's why I'm here telling you about it, because I did it. I made those mistakes. I got stuck in the never-ending cycle of doom, which you don't want to be stuck in. So those strategies, those systems, those different indicators, they all work. But there's a reason they're not working, and that's because you don't have a proper business plan to go with it. So it doesn't matter if you use this price action system that we're using. Totally doesn't matter if you use this, or if you go and use your own indicators. It doesn't matter. As long as you apply the business plan, which is make more on your wins and lose less on your losses, then it becomes irrelevant what system you use. It's important to understand that. Power system operations, morning. FX trader. Look, I thought 10 years was a pretty long time to go wrong. Oddly enough, though, I don't know how you felt, FX, but, with your 20 years, but those 10 years, still, I got through. Profit here, loss there, profit here, loss there, just like now. I mean, we got through it for whatever reason. And I believe even if you don't know, you can still get through if you're lucky enough and you have a few small things in place, because I did incorporate stop loss. I was careful with that. I did watch out for those weekends where there was things going on and stuff. And so, I managed to get through. But I'm actually surprised, but I did. And then thereafter, obviously, when the aha moment stepped in, it was like, oh, hang on, you can actually make quite a large sum of money if you do this right, rather than just ticking along. But yeah, it's interesting. But like you yourself say, FX, it took you 20 years. But in that 20 years, you probably made money. You probably survived or got through. It's just now you're like, oh, wait a minute. There's a bigger picture here. That's all. And that's what happened with me. I just saw, wow, it's like an opening, your mind opening up, and you see a bigger picture. But hang on, it's not just about little lines, little charts, little squiggly lines. The other thing, the other aha moment you've got to have is that these lines, these little candles, these things here, they're not making you the money. It's not an algorithm that you're trading against. This is all human beings trading in the market. These are all the trades that have taken place. This is all the business that is done in the market. In this case, in that 4 hours. If it was a day chart, it would be a day. If it was a 5-minute chart, it would be in 5 minutes. That's all the business that's taken place. Buy and sell. Mostly buy there, mostly sell there, but that's the business that's taking place. That's where all the orders are lying. That's where all the money is lying. That's what the charts are telling you. And if you look, if you're trading, for example, on these things on the side here, which are moving around up and down, the buy and sell price and bid and ask, as they call it here, the volumes and what have you. If you're trading on that and there's no chart on the left here, then you're going to get kind of confused. You're going to look at this trade and say, well, I want to take this trade, how much am I going to pay for it? Let me just draw this out here, make it a bit longer. I suppose it would be nice if I could make it a bit wider, I guess not. Yeah, I see why. Probably got to make these lines a bit wider. But anyway, but if you were just to trade on these little numbers here, for example, it would be very confusing for you to just trade on those little numbers without having a chart. So that's why we have a chart to manage to trade on, because it's not just a number. It's not just a number, but all these numbers are inside those candles, inside that liquidity. And that's basically what it's all about. People don't realize that you're not trading against charts. You're not trading against numbers. You're not trading against robots. These are all human trades in the background. Yes, people put algorithms in place, but understand one thing about that algorithm is that it's controlled by a human being. So if I'm that human being and I create an algorithm that says every single time that a price breaks a level and a certain type of level, then you must buy, and then you must sell at a certain point or follow the stop loss up, give it all the instructions that a robot needs, then the robot will trade according to what I've asked it to do. And it'll just trade that way. And it'll just keep on trading that way until I tell it different. So it's a human being that's controlling the information that that robot's got. The one thing I have figured out about AI, a few of you guys will have noticed that I've been using a bit of AI in between in the background because it's quite helpful and quite useful for the videos and what have you. And the one thing I did learn is that it doesn't listen every single time. It doesn't understand what you told it every single time. So if you do a bot, you're going to have to be insanely careful how you program it, because I noticed that it doesn't listen every single time. It doesn't get it right, but that's because of the instruction that you gave it. So you've got to give it near perfect instruction for it to work properly. So that as well, you know, that's not always the best way to go about it. Look at the fair value gap. I don't actually use the fair value gaps that much. I'll have a look at it now. Back in the old days, you had to take longer term because the slippage and commission round term was often at least. No, in the old days, man, the swaps were huge, man. I mean, we paid huge sums of money for a trade. The buy and sell price was so far apart. And besides, I mean, I would buy the newspaper in the morning, and then, you know, you would like look at the newspaper, buy, and we would buy shares, obviously, and you would buy shares. And then in the evening, I'd buy the newspaper again and see what happened to the shares during the course of that day. So that's 2 newspapers a day that I had to buy. And then I'd go through those pages of share prices and whatnot and decide what I'm going to buy and sell the next day. Very often I would keep those stocks for more than a week, couple of weeks in my portfolio. And it was one-to-one trading. It was spot trading. I mean, you had your money, what you paid is what you got. So yeah, it was a totally different ball game, and it was expensive. Yeah, that's why you had to keep it a long time as well. Because I mean, if you bought this for 1679, I mean, you know, you bought this for 1680. I mean, the sell price would be like 1677 or something equally ridiculous. It was way off, and you had to wait for it to get there. No, it wasn't that simple or that easy. That's for sure. There was a lot of slippage. Are there any fair value gaps here? You see, fair value gap. A fair value gap would be the bottom of that tail and the top of that tail on that candle, in between that candle, so you get a fair value gap there. Comes back up, takes that fair value gap, goes down. That's kind of where the fair value gaps work. Fair value gap is very much another form of system that you can use in your strategy if you want to. But like I say, don't overcomplicate it. Don't get too many things on the go, because you're just going to start confusing yourself. Let's see if there's any fair value gaps here on the, there's a fair value gap right there on the S&P. I mean, if you wanted to draw it in, it's taking it right now. So what's it going to do? So there's a gap, right? So now it comes up, takes that. Is it going to carry on down from there? In all likelihood, yes. So that fair value gap is kind of playing out if you want to trade fair value gaps. If you want to know more about fair value gaps, I do have a video on them somewhere in my system. But also fair value gaps. Remember, fair value gaps, you got one shot. They can't go and hit a fair value gap 10 times. You can't go draw full fair value gaps all the way back here. There's one. There it is. It's the last one. It's hitting that right now. It's taking that money. Probably going to come down from there. That's your fair value gap. That's it. So in all likelihood, if a fair value gap works, it would take that now and go down. Doesn't work, it'll go up. I did my tests on fair value gaps and I found they're kind of neither here nor there. It's half-half. You know, it's not a system that works every time. It does give quite a good result. It's not bad. I got to say, it's not too bad, but it's certainly not the best system. You see now here, this is where it becomes, you know, complicated. Let's say you're using supply and demand. So you're looking for liquidity areas. So there's a supply of money right there. And so this is now, it's in, okay? So there's money there, the liquidity pool. But now the fair value gap is just above that over there. So you're going to draw another one in over there. So in other words, it's going to come and hit the fair value gap. But then are you going to play the fair value gap or are you going to play the liquidity pool? You're starting to confuse yourself. Now you've got too much going on here. You've got too much liquidity going on here. None of these systems are actually going to be the winning system. One of them is going to work for you. Doesn't matter which one. Don't overplay it. Put too much into it. It's just going to confuse you. Okay, if the first and third candles, including the wicks in the third candle series, doesn't overlap, that's a fair value gap. Yes, pretty much so. Yeah, I look at it pretty simply and pretty straightforward. I get that. Where was I looking now? Can't even remember what I looked at now. Yeah. But very much, there's a gap in between and pretty much it. Okay. Was it the Germany 30? Might have been, I don't know. But yeah, those fair value gaps, very much, I think, an ICT concept. I've actually never traded with them. I kind of understand them, but I've never traded with them. See, there's a failed one here. There's a big gap there. It's gone up and broken straight through it and gone up. Didn't work. There's another biggie there, up there. That one, it's neither here nor there. And then there's this biggie over here as well. Yeah, that might work. But it was S&P, wasn't it? I was looking at the S&P. That's it. Yeah. So there is a gap in there. And it's coming in to take it. Fair value gaps. You might know more about them than I do, actually. But from what I've seen, it's not a big win. It can do the job. I mean, it's just like everything else. You're drawing a line in the sand. You're drawing a line in the sand and saying, there's the line in the sand. Let's go according to that. Whether it's supply and demand, whether it's support and resistance, whether it's trend, you're drawing a line in the sand and you're trading with it. So, and then you're using the strategy thereafter. So none of the systems are wrong. None of the systems are wrong. But there is no magic pool and there is no magic system. Every single one just gives you the ability to manage a trade. So if you're trading with fair value gaps, for example, and you decide, now I'm going to use this as my system, then effectively what you're doing is you're saying, when the price gets to that point, then I'm going to buy or sell, and I'm going to put my stop loss at this point and my take profit at that point, and then I'm going to work and manage the trade. So you see, it doesn't matter. Or if you say, I'm going to use supply and demand, you say, when it gets to that level, I'm going to take the trade, and then I'm going to put my stop loss at that level and my take profit over there. And then I'm going to apply my business plan and my strategy. I'm trading support and resistance. When it gets to the support or the resistance, then I'm going to put my stop loss there, and I'm going to put my take profit there, and I'm going to apply my business plan or my strategy. See where I'm going with this, okay? If I'm trading moving average crossover, let's use an indicator. I'm trading moving average crossover, the 8 over the 20 or the 9 over the 20, depends on the person. Everybody's got a different view on that. And when it crosses over, I take the trade. Then I'm just going to take the trade, and I'm going to put my stop loss there, and I'll put my take profit there, and I'm going to apply my business plan and my strategy. That's where I go with it every single time. So it doesn't matter which system you want to use. You can use any system you want. You might want to use stochastic, MACD, RSI. Doesn't matter. As long as you apply the business plan, you'll be okay. It was the first and third. Yeah, it was the Nasdaq. ICT stuff is a bunch of overcomplicated nonsense, if you ask me. I am Blue Mango. Yeah, okay. It's a trigger to give people the core courage to enter the market. Exactly. That's what I say. Well, any system that you trade with, it's the one where it's a trigger to give you the courage to enter the market. And it's also that thing that gives you the ability to manage your trade. Because now you're in the trade. Now you've taken the trade because you've got the belief that you've done the right thing, that you've taken the right trade, because all of your learning and all of your study and acceptance of that particular system is that if you take the trade at that point, then it should do that, okay? It's not always going to do it because, assumption is the mother of all evil, but it's objective. So you're looking at it and saying, if it does that, it should do that. And then you follow that principle. But at the end of the day, it comes down to simply applying the business plan and applying the strategy. A lot of people have said to me, Rob, your videos are all the same. That's because my strategy doesn't change. I'm not going to change my strategy to make a better video. The strategy and the business plan has to remain the same. I can show you different systems. Yeah, there's millions of different systems on the charts that you can apply, but the strategy must always remain the same. It can't change. And then it doesn't matter what system you apply. Blue Mango says ICT is very overcomplicated. Look, there was a lot of, how can I put this? A lot of noise around that particular system and what went on there. And they basically based their system effectively on what we trade, which is support and resistance, or maybe even on the Wyckoff system, okay, which is what this is based on as well. But instead of simplifying it like we did, they overcomplicated it and went in all directions with it, okay? Their system will work, obviously, but they just made it so complicated that traders couldn't just get to the bottom of it and figure it out properly. And there was all kinds of different ideas as to how it should work and why it should work. And so unfortunately, very unfortunately, a lot of traders got too confused, and they just went the wrong way with it as far as I'm concerned, and overcomplicated it for traders. The way I've put it is I've taken a standard support and resistance Wyckoff type system and basically simplified it down into the easiest possible way to trade without anything overcomplicated. And then if you really want to, you can add in a few different things. The difficulty of trading as well is over the many years of trading, you trade with a bunch of different systems, or you learn a bunch of different systems. So you tend to apply them, and you tend to apply too many when you're trading. So you over-apply your systems into your strategy. So you try this and you try that. What if I do this? What if I check this? What if I check that? So you kind of complicate your own brain by overcomplicating what you're doing, by applying all those things, because knowing too much is not always good for a trader. Knowing too much can actually be quite bad for a trader as well. If you know too much, you get too much on the chart, too much going on, you start applying too much knowledge, and then you confuse the hell out of yourself. What I find a lot of traders do as well, I don't know if you guys have found this, but a lot of traders make a lot of extra work for themselves. You know, the first thing a lot of traders will teach you, will tell you, is you must have a journal. Now, I don't disagree with this. I don't disagree with this at all, because what's wrong with going back and checking what you did and seeing if you did the right thing or the wrong thing, or why you took a trade, or whatever the case, or, you know, that whatever. But I question all the extra work that these traders make. They create spreadsheets and loads of different things going on and what have you, and then they start inventing things that check which way the market's moving and what it's doing, and adding all kinds of formulas in and whatnot, spending hours doing that. And I believe it's because traders are bored, because you can't trade all the time, so you find something else to make it more acceptable to your psychology, let's say. You know, when effectively all you really need, or in the past, all I really needed was some kind of spreadsheet which told me how much I was profiting or losing. But I don't even need that anymore, because I can just draw a statement from the broker automatically off the computer. And you've been able to do that for years. So you really don't need a spreadsheet for that. And then the trades that you took and why you took them, that's also available to you on your statement of account with your brokers. So you can check what trades you took, and then you can basically remember why you took them. You don't need to write it down. Most people will remember why you made the mistake, or what foolish mistake you made, or you'll know right at that point when you did it. And what I found when I was trying to journal in the past years ago was I didn't really put that much into the journal. I didn't really go back on it that heavily and say, I took that trade, let me go and do all kinds of analysis on it. I didn't spend the time, because I would need to spend that time on the weekend doing that, which I was doing other things. So, no, I'm not a firm believer in a full-on journal either. It's total, for me, it was a total waste of time. Most of the stuff, when you make a mistake, you know you've made a mistake. You don't need a journal to tell you you've made a mistake. When you've done it right, you know you've done it right. You don't need a journal to tell you how or why you did it right. All you need is your statement, which you can get off the account. All you need to know what trades you took is your statement, which you can get off the account. And so that all that work, not needed. And then there's a whole bunch of other research that traders go into that's been done for you. For example, so many traders will go and they'll start trying to reinvent the wheel on a system and go into doing all kinds of homework on a trade and this and that and the other, when all these indicators and all this information and all this support and resistance and price action and everything, the charts, it's all done for you. It's all automatic. It's there. What are you actually doing? What are you actually doing going back and trying to figure all this out? Keep it simple. Don't get complicated. The charts are like a book. They're a picture. They're telling you what's happening. If you want a little bit more information, just make the charts a bit wider and just go and have a look. It's not rocket science. You don't need to overcomplicate this. And I've seen a lot of traders get really, really complicated, really get into it and do a lot of extra work that you really don't need to do. But if you want to do that, that's fine by me. I'm not going to stop you, that's for sure. Yeah. But yeah, there's a lot of guys that do that. So many guys that get involved in overcomplicating it, doing far too much, spending hours drawing all these little things and putting all these little pictures in and whatnot. And I just can't see how they're going to help you. You know, there are some guys that sort of are some top traders that are able to maybe design their own research on, for example, what happens every week when the market opens at this time, okay? And for the last 3 weeks on a Thursday, when the market opens, it goes up. Okay, that's kind of seasonality in its own way. Because what you're doing is you're taking short-term seasonality and you're researching it and working out what happens on a Thursday, what happens on a Friday to the DAX, for example, what happens on a Monday. But then you have to research it right down generally to one instrument like DAX or S&P or something like that, or the Euro, US dollar or whatever, and say, at this time of the day when the market opens, that happens. And it's happened for the last 3 weeks, so surely it's just going to keep on happening, you know. So you can start basing it on odds. That's very much a short-term seasonality that you're working on. That kind of research, I get that. That's something completely different. And that is just you checking the past and what might happen in the future. That kind of homework you can do. That's different. But this business of just making up spreadsheets for no real reason and, you know, that sort of stuff, not going to help you much. It's not going to help you choose your trades, let's say. What you need, very much like was said here, is you need a trigger to help you take the trade. And obviously you also just need that confidence to feel that you're doing the right thing when you take a trade. So it'll be interesting to see if we get the Christmas rally. It'll be interesting to see if the markets decide to go up or down. S&P is closing that so-called fair value gap and going past it. Looks like it might go long. I think it might go up to the trend resistance and then come down. And that's probably where it's going to end up at the end of the day. But guys, I'm probably going to have to head on now. It's been a while. We've been doing the video for quite a while. For those of you who missed the one strategy that I spoke about at the beginning of the video, just go back to the beginning of the video and go and watch it. I will try and bring out a standard video which goes over it all again, and you can follow that as well. But if the session helped you see how powerful one simple setup can be across multiple markets, then if you haven't subscribed, make sure you subscribe now so you can join us for the other live shows. My channel is all about clarity over complexity. No strategy hopping, no system hopping. We stick to keeping it simple. No hype. We stay with one trading strategy that actually works. So you don't want to miss any live breakdowns or any of my trading shows. On Thursday, we will have another live show, even though it's Christmas time and that time of the year. We will have another live show, but this time I'm not doing it 1400 GMT plus 2. I'm bringing it forward, and I'm doing it this session because it seems like the European session is more in it for the live show. So I'm going to do it for you guys because you guys are the larger audience that comes here and what have you. So I'm going to do it, but on Thursday, I'm going to do it at 1200 GMT plus 2, an hour later than the Thursday show, just an hour later. That's for my own personal reasons. But we'll do it at 1200 GMT plus 2 instead of 1400 GM plus 2. Hopefully that suits you guys better and works out for you guys. But it does kind of, I think, suit the European session a little bit better as well. So comment that trading smarter, not harder is a good thing. Don't forget to like this video, and I'll spot you guys soon. On that note, thanks for watching. I hope you guys make lots of money, and I hope I'll see you back here on Thursday at 1200 GMT plus 2 for our next live show, and we'll go on about some other thing that'll be important to you.